We have to start thinking longer term.
But again, I go back to, did we not have a choice that we had to think short term because we don't know what kind of crisis or Armageddon that everybody was talking about that we might have achieved?
There were certain things that had to be done. Certainly there was a bank run, et cetera. We had to do something. However, Obama should have reversed course after that got stopped. We need to start thinking about production rather than consumption. We can't reignite the housing bubble again. It seems like the new policy is we have to get real estate back to the old prices. That's ridiculous.
Well, you know, people tend to think that the sectors that got us into this need to lead us out of it, and that just never happens. You know, the guys that blow up, well, they need to recuperate for a long period of time. But I think that in terms of your production idea, David, the export sector in the U.S. is now hyper-competitive because of a weak dollar and contracting unit labor costs. I think it's going to take market share from the Europeans and the Japanese. And number two, what we have...
That's a lasting impact, do you think?
I think that's a long-term story now. I think U.S. exports are going to be very competitive. And number two, I think the middle-class U.S. consumer is going to remain lethargic for many years to come. I totally buy that. But we haven't talked about the capital expenditure cycle. Across the world, companies have a lot of cash. They've raised a lot of money in the corporate bond market. Their bankers are more willing to lend money to them, and their stuff is very old. So I think we're at the cusp of a new capex cycle. And so the sources of growth are going to be different, exports and capex.
All right, we're back talking with David Tice, Chief Portfolio Strategist for Bear Markets at Federated Investors. Also with us, Ajay Kapoor, Global Strategist at Murray Asset Securities. So, David, just before the break, Ajay was making, making points about where growth comes from going forward. What are your thoughts about that? He talked about, various things.
I dispute a little bit what Ajay just said as far as capital spending, because fixed corporate investment has really been down for the last couple quarters. It has not been positive at all. And when you look at capacity utilization, where there's so much slack right now, I don't think a lot of money is to be spent there either, because there's not much demand coming from customers, and therefore they're going to, I don't think they're going to spend a lot.
But don't they have, I mean, if you see sales and revenues rise?
Well, capital goods orders are now picking up globally. And just on the cap utilization story, this is like saying, I have a black and white TV. I'm just watching half an hour of TV every day. That's like a low utilization of your TV because it's a very old TV you shouldn't have. Once you get the big HD TV, you'll be watching 5 hours of TV every day. So just because you have old capex and you're not using it has no predictive power for new capacity.
It's true about the TV.
Hey, I want to talk about, though, investment strategy, because, David, I know we've talked with you a lot, and you talk about the S&P going to 400. You still are on that front?
And bear market funds have been so popular this year, right? Record inflows into bear market funds.
Well, our assets are not that much higher than they were about 18 months ago. So, frankly, people have not been clamoring to get into prudent bear.
But you're still pretty negative, right?
Yeah, we're still very, very negative. In fact, investor sentiment, recent investor intelligence survey showed bears at 16.7%, which I think is a 5-year low. So there's very, very positive sentiment.
What's going to bring us down?
Well, we think there's a number of things. I do think earnings are going to potentially come in lower. I think we're going to have a potential for higher interest rates. I think there could be a funding crisis. There could be a continued decline in the dollar.
Let me break in about earnings, because you actually think earnings recovery will be super strong next year.
Absolutely. I think earnings are going to be, well, already analysts are looking for about 20 to 25%. I think actually could be higher. If I'm right that the world, especially emerging markets and the U.S. and even Europe now, recovers quite nicely. This year, remember, analysts got the cost-cutting story wrong. Costs have been cut pretty aggressively. And I think next year, the story that's going to be wrong is that the top-line numbers are going to pick up quite nicely. You get 6-7% nominal GDP growth with operating leverage. Earnings numbers kick in very, very nicely.
All right, so you guys are not going to agree on these scenarios. We can let the viewer decide which one he agrees with, and then just tell us how you set up for the scenario that you're expecting. I mean, as far as an investor, what do you do here?
We think investors ought to be defensive. This is a time to protect principal, not worried about earning a lot of money. We offer a Federated Prudent Bear Fund that is short stocks. We think it provides a great hedge for your other long investments. We also like resource stocks because resource companies are doing very, very well in this kind of fiat money environment.
How about you, Ajay?
I think that you should be buying stocks with higher dividend yields now, get some income that way. And I think sectors like technology on my CapEx team looks pretty good. I like some of the emerging market banks. So those are kind of sectors that we're looking at here.
Do you guys agree on commodities? I mean,
Well, I think commodity prices are going to go up if my scenario of world activity picking up is true.
Just pure demand here.
Yeah, absolutely, and not that much supply, not that much capex. And I forgot to mention energy stocks, which I also like quite a bit as a part of that commodity theme.
I generally say I agree, but partly from demand, but also just from institutions moving away from paper to stuff, because as it preserves value.
Let me quickly ask you your concerns about inflation. Are you still very concerned about inflation? We only got 10 seconds here.
Inflation down the road, not immediately, but yes, down the road.
All right, David, thanks for joining us. David Tice, Ajay Kapoor, thanks so much for sticking around.
Appreciate it.
Thank you.